The four of them were all picked for a reason, one of which is I've done business with all four of them, two of which I've known them all for many, many years. So highly respect and value their opinions and their observations. And so thank you all for joining us. As I weave my way left, Lisa Holter Ankel is an attorney at Avisen Legal. Jeff Liebl is president and CEO of GeoComm, and then Troy Rosenbrook, president of Highland Bank, and last but not least, Mike Harvath, president and CEO of Revenue Rocket. Mike will tell you more about his business, but Mike worked on an engagement for searching for an acquisition partner for one of my portfolio companies. Troy and I have been involved with Highland Bank for about 8 years. In fact, we were like kind of in the same orientation group. So anyway, and then Troy has a lake place up in Northwest Wisconsin who I was talking to a few people about earlier. And anybody knows anything about folks that hang around Northwest Wisconsin, they're fun guys. So I'll say that about Troy, speaking from firsthand experience. And then as I was thinking about Jeff actually got his very first job post-college at the place I was working at. So there was a lot of stories about Jeff, but I didn't want to say anything here in this environment that maybe would convey some of the things I do know about Jeff. Other than, as I was thinking about Jeff, we both share a love for Elvis Presley. So that was going to be the little nugget I was going to say about Jeff. And then lastly, Lisa Holter Ankel. Again, Lisa and I have known each other and done work together over about a 20-year period. So thank you all for being here. I appreciate it very much. I'm going to go through, I'm going to ask some individual questions, and then let's start with you also saying a little bit about your background, and then we'll get to some questions. So why don't we start with Jeff. You're the buy-side person here. You've advised businesses, started businesses, ran businesses, and we were involved in one business in particular where there was an acquisition involved by an entrepreneur as a way to get into business, like our topic today. So first, tell everybody a little bit about your background, who you are, and then I got a couple of questions for you.
All right. Oh, there we go. I speak loudly, but I probably don't need this, but this helps. Thanks, Rick. I appreciate it. Yeah, so Jeff Liebl, I'm the president and CEO of GeoComm, a company based here in Minnesota, although that's probably not why I'm on this panel. I have known Rick for most of my life. I did start my career a block or two from here in the old Fauché Tower, working for a boutique consulting strategy and M&A advisory firm known as Smaby Group. And Rick taught me a few things. I was a research analyst. He was handling deals and investments, and that was a whole lot of fun. So fortunately, since it was 30 years ago, fortunately, we obviously started our professional careers right after elementary school, right?
Yes, exactly.
So we're sticking with that. So my background, I'm an operating executive. I've worked here in Minnesota for tech companies in Silicon Valley, New York, and for one based in the UK my whole career. And I've had a variety of experiences working for publicly traded companies, working for as part of venture capital funded startups that have raised in excess of $250 million from various Sand Hill Road to local Minnesota VCs, et cetera. I've been a part of a small IPO on the London Stock Exchange. I helped spin off a company to get 2 bites at the apple. I've been involved in the after effects of acquisitions as an operating executive, and I've worked, and in fact, I had the opportunity to start a company, acquire an IP, a software asset, as part of a PE sell of a company and start my own business almost 10 years ago, and I've in the last 20 years been a part of through consulting and advisory worked with folks such as Rick to help other tech companies grow and succeed, and that's include some exits.
So as the business operator here, Jeff, tell us what's kind of the first thing that you might focus on when you're assessing a business to, say, acquire and or invest or partner with from your experience?
Yeah, sure. So it's hard for me because there's a lot of firsts. But if you want to pick a first thing, I think one of the things that I tend to really emphasize is the value, the quality and nature of the revenue. So is it a recurring revenue model? I have a strong bias towards sticky, predictable, recurring revenue models. And also, what's the customer concentration? Is there one or two clients that constitute a majority of that company's revenue? How stable is that? And what are the nature of the long-term contracts or month-to-month? Understanding the quality and sustainability of the revenue for me is a big one.
Great. How about TimeSolve, the business that I was referring to earlier that we both worked on? It was a great acquisition success story. The entrepreneur bought it. You and I both supported him in his journey. Describe that situation, and what do you think the reason was in hindsight, looking back, for their success?
Sure. So long before you got me involved in that with you, Rick, the founder had acquired a product out of a large legal information services business here in the Twin Cities, and it was kind of an orphan product, if you will, and he bootstrapped, I think, for quite a number of years, and ultimately we were part of an advisory board with him to help him grow and accelerate what he was doing. And get a strong MRR, ARR model going, which ultimately ended in a successful exit for him with a PE firm that was targeting his vertical industry. And I think in looking at that, and in the number of years I was involved on a monthly basis with that firm, I think one of the things that one of the terms I like to use is stick-to-itiveness. That when you're, you have to persevere. This was not a quick buy it and flip it sort of journey. This was, rolling up your sleeves, working hard, understanding your markets. He had a great technology partner. They built a great product. They made some good technology bets. They focused in on what they were good at. They didn't dilute and try to do too many things for too many types of customers. They were open to outside advice, trying things, failing fast, and over quite a number of years, built up a good, strong brand reputation in his vertical niche, and got us a good sales and marketing engine around that to accelerate top-line growth, and that brought would-be acquirers, would-be investors to them, and so I think it was one of those things where he earned it. They earned it over time, and his ability to be open to other outside experts and other thoughts to help him try things to complement his strengths, I think was key to that.
All right, great. Lisa, let's jump over to you. Your legal practice is focused on business law, M&A, private equity transactions. I know you've closed hundreds of transactions over the years. I know I've worked on a number of projects with you. Tell us a little bit about your practice, and then I have a couple of questions for you.
Sure. So I'm with Avisen Legal. It's a boutique business law firm. I've been practicing around 30 years. We always laugh. I've been practicing. I'll get it right someday. I work mostly with closely held, privately owned businesses, family owned, maybe a couple principals. And I do a lot of M&A, but I also say I do a lot of things that relate to the life cycle of a business. So when you form a business, I can help with that. Bring in employees, maybe incent them with ownership, bring in other owners, passive owners, partners, need to think about control between the parties, sharing of distributions, economics, things like that. I've done a lot of acquisitions, as Rick says. And so a lot of my work involves where a company grows through acquisition or representing a founder at the time of sale. Okay. And in my previous life, I worked in banking and public accounting and some Fortune 500 companies. I have a finance background, and I'm currently CFO of my law firm too. So I think I bring sort of a more practical and numbers-oriented approach to advising my clients.
And one of the way you advise clients are through a search fund, and I'll give you an opportunity to describe that a little bit for people in the audience who maybe don't know that, but many first-time buyers of businesses look to get into entrepreneurship through search funds. So what are a search fund, for those of you who in the audience who don't know, and then how does somebody go about doing that?
Yeah. So search funds started out of big business schools, Stanford and Harvard, where someone getting an MBA decided, and usually they would come from industry and have a lot of industry experience prior to that, and they wanted to run their own business, but didn't necessarily have the capital to do it, but maybe a great skill set and probably a good network of people to raise money from. And so the idea of a search fund is really helping someone fund the time period where they're searching for the business, and then the acquisition. And so money comes in two stages. First, a smaller amount at the outset to fund the search, so cover basic salary, administrative costs, and probably travel relating to the search and due diligence. And then the larger portion at the time of close, where the investor gets significant equity in the company. And there's probably debt in the capital stack as well. For the risk that the investor took by fronting money for the search, that search capital gets converted into equity in the deal when it closes, and usually at a stepped-up basis at about 150%. So if someone funds the search at $200,000, they get $300,000 of equity just for free, for no more investment in the final in the acquisition entity. And generally, you want someone who's investing not with just enough capital to fund your search, but who's going to be there to bring in the real capital you need to fund the acquisition. And so the principal, their primary benefit is they get equity in the deal. And usually in these cases, there's one or two people. And so one person might get up to 20% equity in the company that's acquired. Two people might get up to 30% equity. And it comes in usually three stages, three equal parts. First, third at the time of the close, when the deal closes. The next third will vest over time, usually 4 to 5 years. You want those principals around running the business, incented, interests aligned. And then the final third comes at the time of exit, if the exit price is sufficient to give the investor a minimum internal rate of return. And that's from 20 to 35% generally, but probably closer to 30 to 35% is more common. And the investor's equity is going to have preferences over the principal's equity. So the investor will first get there, so there's sort of a waterfall. And it's sort of similar to private equity funds, if you're familiar with that. The investor gets their money back first. They'll get a nominal return on that money of maybe 6 to 8%. And then after that, it would be shared. So if the principal did get the full 20%, then it's shared, 80-20. So that is, what a search fund is. I think I've started to see that in the Midwest in the last 6-8 years, mostly self-funded searchers, but for people with a strong network, it is a way of acquiring a business larger than they would be able to do self-funding. The flip side is, it's a larger pie, you're getting a smaller piece, because if you're kind of self-funding, you're going to have control over the company, perhaps 100% of the equity.
Great. Without getting too far into the weeds, what are 1, 2, 3 of the key legal issues that are most important to an entrepreneur who's looking at acquiring a business?
Yeah, so if you're buying a business in your purchase agreement, you want to think about, I'll focus on two things. The structure of the acquisition, is it a stock or an asset deal? Asset deals, buyers prefer. You pick and choose the liabilities you take, so you don't have to take everything. You don't get historical unknown liabilities, and you get a step up in basis. There may or may not be 2 levels of tax on the seller. Most sellers nowadays are going to be organized as an LLC or S Corp, so that there is only 1 level of tax, but historically you got to keep in mind sellers prefer the stock deal. So in the asset deal, you're buying assets from the business itself. You got to move everything over and set up the payroll, bring employees on, do the onboarding, move over, customer payments, all the logistics. In a stock deal, the seller is the person or group of people who own the business, and they pass the business over to you, and It just stays exactly the same way it is. And you don't get a step up in basis as a buyer, and the seller definitely only has one level of tax. You are subject to all the unknown liabilities of the business. So another thing, even in an asset deal, that you want to think about is indemnification in your purchase agreement. As a buyer, you don't want to buy a business as is, where is. Many sellers will say, come do your due diligence, and that's it. Like, I'm not repping the business. That is not market. You should expect comprehensive representations about how the businesses have been run. It's been run in compliance with law. The inventory is merchantable. The receivables are collectible. They have clear title to the assets, things like that. And then if those things aren't true, and that's determined after closing, then you have rights to go back against the seller, to be indemnified, to be made whole, to be reimbursed, in essence.
Great.
And there's limits on that, but that's generally how it is.
Cool. Mike, jumping down to you, your business is unique in that a lot of firms focus on the sell side. Your firm does both buy side and sell side transactions. So tell us a little bit about your background and your firm.
Sure thing. Okay. Well, I'm kind of a loudmouth, so maybe everybody can hear me. A little bit about my background. I started my career at Apple, helping design a little computer called a Macintosh. Ultimately moved on to working in distribution in the tech space for a while, and then successfully started, grew, and sold 3 IT services companies. Last firm I owned, we bought 7 firms before the exit. When I exited that firm, I said, wow, there's really a need for an advisor, mid-market investment bank focused on this market that's run by an operator. That was 25 years ago. We just kind of surpassed 25 years in business. Yes, we do both represent buyers and represent sellers. The lion's share of those clients are in the, as I mentioned, IT services space. We facilitated over 300 transactions in 30 countries since I formed the firm. And we also do growth strategy advisory in that space. Buy side is an interesting side of the business. I think there was some discussion here by the panel about what that's about. It's really about helping people grow. When I formed the firm, the founding tenet was, hey, let's help people grow this business, their businesses through acquisition. Let's help them grow organically. And ultimately, we'll be in a good place all the way around. It was a supporting tenet of my way to kind of give back. Along the way, we started to being asked by those clients to help them exit. So we started representing them on the sell side. And, as I said, done a few deals over the years.
Yes, you have. Speaking of doing deals, looks like 25 is going to be a big year. One of my portfolio companies got sold early this year. We're getting a lot of calls from private equity firms. What's your view on the year, and how do you see things shaping up for 2025?
Well, 25, looks like to be another record year. We sort of saw a dip a couple of years ago. But certainly 24 was very strong, and 25 should be a record year, actually, for M&A transactions, particularly in our space. There's just a ton of capital that is flowing into the market. I think that sort of rides the wave also of the take privates. We've all seen over the last few years a huge number of companies sort of go private. We continue to see that in the tech space. But more importantly, I think private equity has completely transformed the market probably in the last 7 to 8 years as it relates to, at least in the tech space, consolidation, driving consolidation, and looking for areas to invest. So I think 25 looks to be a great year.
Good. Good for all of us. Two-part question here. Given that a lot of your clients are out buying, what's the main thing that you suggest that they look at for those out in the market looking to buy a business? And then the inverse of that is for a company that's thinking about selling, what's kind of the one thing you might tell them or coach them to focus on as they prep to go out to market?
Yeah, I think when we target companies for our clients to buy, really, all deals have to line up strategically, culturally, and financially. Pretty important. We kind of call it the trifecta of M&A. Those are super important attributes as you think about buying a company. But maybe even more importantly, there's been a discussion here earlier about sort of the quality of the revenue on the revenue trajectory. But I would also add the quality of the profit and the profit trajectory. We try to target companies that are in the top quartile of both revenue growth and profit realization for our buy-side clients. Typically, if they line up on that trifecta I just mentioned, they'll do well.
Okay. Troy, jumping over to you. You've been in the banking industry for a couple of years, funded a few businesses and acquisitions over those years. Tell us a little bit about you and your background.
Sure. As Rick said, I've been in commercial banking for a little over 40 years at this point, really both on the large corporate bank and also community bank side. And, have had the opportunity to work with everything from the local hardware store up through more middle market size businesses, and provided various forms of financing for them. As far as Highland Bank is concerned, we're really in the business banking, lower middle market space. So that looks like, the easiest way to describe that to most owners is how much money can I borrow? And that just kind of, asset size doesn't matter. So, for us, that looks like senior debt of someplace in the, $8 to $13 million range. So that puts a certain level of EBITDA in there and a certain multiple, and that gives everyone a pretty good sense of where we sit. In terms of our role in this process, a lot of things that have been brought up already. We're generally a little later in the game than on the buy side or sell side, where they're trying to help fund the acquisition. We're always playing a senior debt role, not mezz or not anything else, and so that's where we fit in the process.
Okay. Talk a little bit more specific to Highland Bank. Let's say somebody's in the audience here and they're looking to finance a deal. What's a good profile of a client for Highland Bank, and how might somebody approach you or one of your bankers at Highland Bank and articulate what they're doing?
Sure. We're fairly industry agnostic. I mean, we have, I would say, most every kind of industry in our portfolio. We have manufacturers and wholesalers and distributors and service businesses, and so we're interested in most of those. We probably stay away from hospitality a little bit, but other than that, we're pretty much open to the type of business. And in terms of the kinds of transactions, we're also pretty flexible there too. We certainly have had minorities buy out majorities and majorities buy out minorities. We've had spin-offs out of larger corporations. We've had some search fund financings as well. So, we're not as particular with the type of industry or the type of structure. We're more interested in making sure that the parties that are coming together understand the business and as mentioned earlier, have repeatable income that can repay our debt. That's kind of what we're sort of about. And so, that's a seems like an obvious answer, but sometimes we don't get there all the time.
Yeah, of course. We heard from Mike that from a M&A perspective, a lot of potential buyers out there, in particular in the private equity world. Mike thinks as do I, the 25 is going to be a great year, shaping up to look like that. What's the current appetite at Highland Bank to fund acquisitions right now?
Yeah, I would say we're having a really strong first quarter in terms of appetite and in terms of new deal success. I think in the last 60 days, we probably have maybe 6 signed proposals that are in various stages of closing, all related to some kind of acquisition financing. And so we see a lot of activity. I would say mostly good activity. Sometimes you get it, something that just doesn't work. But I would say it's the quality of the opportunities is also improving, not just the quantity. So we have a good appetite for that. It's a good space for us to be in. We will do both a conventional financing as well as SBA financing, which really is helpful for some people in terms of not necessarily bringing as much capital to the table.
Okay. I am going to shift gears a little bit, not to throw you too much of a curveball, but I'm going to steer questions towards each one of you. Jeff, I'm going to start with you. Is the why of an acquisition relevant? You've been involved at many different levels, as you said earlier, with acquisitions, meaning does the business buyer need to be real clear on what they want to get out of the acquisition, meaning are they in it just for a paycheck? Are they looking to work for themselves? Are they trying to create partnerships for their business, which I know you've done? Or are they looking for some kind of big exit? How important is the why for the buyer in a transaction?
Yeah, I think you might have partially answered it already, Rick, with that. But yeah, I think it's extremely important to understand the why, what your motivations are going into it. Is it like you said, because it can affect how you want to finance it, for example. And if you don't understand the why going in, it can get confusing really fast. Like you said, some people are simply looking to buy themselves a job at a very micro level. At a corporate level, the why might be you're trying to extend your business into higher growth areas, for example, or you're trying to acquire talent that you don't have in-house. And so this is really a wide divergence of whys, depending on the scenario. So from my standpoint, if the why is also, for example, you're confident that with the assets you bring to this acquisition, you can accelerate growth and 10x the value of this thing and exit it in X number of years, then that dictates a whole bunch of potentially different financing decisions up front and downstream. And so you have to really be clear about that why going in. Otherwise, like I said, it can get really muddy fast.
Great, thank you. Mike, down to you. When you're out looking for an acquisition candidate for one of your clients or selling a business, how important is the entrepreneur's support team, their attorneys, the CPA, their board, stuff like that?
Yeah, super important. I often say to get deals done successfully, it takes a village, right? Certainly you need to have very competent advisors if you're a seller. Both on the finance and accounting side as well as the legal side, and I think also on the M&A advisory side, investment banking side, it is money well spent to make sure you have a competent advisor. If I flip that on its head, I'd say same story on the buy side. There's lots and lots of things to negotiate, and frankly, things that probably you've never been involved in before. You may have grown a great business. And now thinking that you're going to move into an acquisitive strategy, and we've hinted at some of them today, but there's hundreds of things that could put your deal at risk if you don't have a competent advisory team helping you.
All right.
Rick, could I just add to that?
Yeah, absolutely.
Yeah, I think it's critically important for that first-time buyer, especially that first-time buyer that maybe is coming out of a corporate situation, right? They've got their 10 or 15 years in and they want to do their own thing, and so they find a target, they have help buying that target, but what they're used to is having an HR department, having a finance department, having all these other support mechanisms around them when they're in that corporate world, and they show up day one in their new role as owner of this business and have none of those things around them if they haven't built them. So that first day when there's that first question and they're used to calling an internal resource, that internal resource isn't there. And so I think it's critically important for that first time entrepreneur, especially if they came out of a corporate setting. They're just used to more support around them.
All right. Troy, let's stay with you.
Is that a penalty because I spoke up?
What?
Is it a penalty because I spoke up?
Well, yeah, I got a time here, and I'm going to cut you out a question. No, I'm kidding. Staying with you, Business buyers are doing due diligence. They need to get comfortable. You as a banker are trying to decide if you're going to finance a deal. How do business buyers get comfortable with kind of the financials and the due diligence items that they're working through?
Yeah, and part of that answer, as any good bankers would say, is it depends. Size sort of matters. If it's a small acquisition, small company, you're not going to get audited financial statements. You're not going to get a quality of earnings report. You're not going to get those kinds of things. And so for there, it's really hands-on, spending time with the business owner, really understanding what's going on. As you move up market, you now have more resources. You might be able to get an audited statement, or you might be able to get a portion of that statement audited. You might be able to get a collateral audit, or you might be able to do a quality of earnings report. And so those are the kinds of things that, as you move up, in some respects, make those acquisitions easier, in that you just have better information. And so, that's where I think, for example, because of the unknown, you start to see a lot more seller debt in those kinds of transactions to allow for missteps in gathering that information during due diligence process.
I'm going to weigh in on one more topic there. Having again, back to the previous question, Rick, having a competent set of advisors, being able to really be comfortable with those cash flows and getting those tied out through that due diligence process. You can call it QV, we mentioned that, quality of earnings, maybe quality of earnings light even for a smaller business is a term we use internally. Super critical. You want to have outside, finance experts really looking at that business from an objective lens to understand and, for lack of a better term, certify those cash flows as being accurate. It's critical in calculating your own return rates around IRR and ROI timelines, but it's also going to help a bunch when you're working with a bank to help them get that deal financed.
Okay, great, thank you. Lisa, let's jump down to you. You mentioned earlier, not only do you wear your lawyer cap, but you have a finance and accounting background. What pitfalls tend to be hidden or maybe overlooked during a due diligence process?
Yeah, as a lawyer, getting a question about due diligence in front of a large group, I'm always a little worried to answer. I'm going to put someone to sleep. But I think one kind of big picture thing to not overlook is the process itself and information that you glean outside of the substance of the documents. So if you're asking the seller for a lot of sort of sliced and diced financial information or customer information, how quickly can they get it to you? Does it make sense? That's going to tell you a lot about their informational systems, their finance system, how they do their books. The documents that come, are they complete? Are they signed? Are they dated? If the due diligence is, missing aspects, well, what is missing in their business? Is the seller organized? Are they responsive? Are they the holdup? Are they not? And sometimes they do want to keep a very small team of people, right? But, are they someone who's not let others in and they're the only person who knows things? So you're going to learn a lot from the process outside of the documents themselves. I don't know that that's a pitfall. It's just, I think, something that is often overlooked.
All right, great, thank you.
Rick, if I could add to that, just coming from maybe a slightly different angle at that, pitfalls and I've kind of seen this in my career firsthand, is making sure that if you're acquiring a business that has significant, as a knowledge business, you have knowledge workers, it's really critical to understand, are they going to be around after you buy the business? Is there retention, or are you going to see a lot of the value walk out the door after the transaction's completed? And I think also partly related to that is understanding, are these cultures compatible? If you're one enterprise and you're buying another one, maybe it might be quite a bit smaller, have a different duration, lots of different things. Can these cultures meld together effectively and create the synergy you're looking for in one company? That's another potential pitfall for, even though maybe the numbers look good and things are tying out, but these are the intangibles that I think can make acquisitions fail.
All right. Very good point. All right. Shifting gears a little bit to a lightning round. So a quick, short, hard-hitting nugget of information for folks thinking about, especially for first time, taking OPM, other people's money, whether it's money from a search fund investor, whether it's an angel investor, whether it's a private equity firm or any other type of investor. What's a quick nugget to tell somebody who maybe is taking OPM, other people's money, for the very first time?
I'll just say, make sure that your goals and their goals align in terms of what you want to do with that business. And for many people, using other people's money, the other people want their money back. And so is the timing of when they want their money back consistent with when you're going to be able to deliver? So, there's usually an exit in the future. And so you have to be good with that plan of an exit. And it has to be consistent with what you want to do with that business.
And I would say, building on that, depending on the amount of equity you've taken, do you have control? Chances are an investor is not going to be running the business day to day with you, but timing of the exit. Is this the right buyer? Is this the right price? You may not be able to get to decide those things either. And so that's, and CapEx investments in the business, things like that, have to be, understand what that means when you take money from another party.
I would just add too, so OPM, other people's money, making sure you understand what role that they're going to play in this. Are they simply financing it and you're now running this, or are they going to is their expectation as a PE firm with dozens of operational consultants coming in to help you run and optimize the business? You better be really clear about that.
I would also add, make sure you understand the terms. We've certainly seen a lot of entrepreneurs take OPM with not very favorable terms as an operator from an operator's chair. And certainly that is a big mistake that can bite you. So understand the terms and also do some scenario planning in that, accepting that money pursuant to those terms, so you know what happens if things go swimmingly, but also if things go less than well.
Okay, speaking of things not going less than well, which occasionally happens. I know you all make perfect decisions, as do I, but every once in a while deals don't work. Say one thing that maybe you learned based on an acquisition that didn't go as planned, and what you took away from observing that.
I'll go to one right away. Culture is king in an acquisition. Oh man. I think we often say that one of the most critical and some most overlooked scenarios in an acquisition due diligence is our culture aligned. That can be as it relates to investment, and alignment around investment scenarios could be aligned in outcomes pursuant to the acquisition. We think that, and what we found is that if you can get to a qualitative analysis of that, quantitative analysis of that culture, pursuant to buyers and sellers, and then apply that review, it helps give you a much more objective understanding versus focusing all your energy on getting the deal done, which many buyers and sellers do. And then they wake up the next day and realize, oh man, what do we do here? Our cultures are very divergent. We can't really work together. Make sure you do extensive diligence on culture and make sure you're aligned.
What he said.
I'd add, I've been practicing law 30 years, and I would say in my experience, indemnification claims are not common. But one of the things that I have seen come up more often when there are these kinds of claims relate to warranty claims. And so if you're buying a business that has a type of product or service that's warrantied, and so it's probably less, software and more manufacturing, But you want to understand what their history of warranty claims is, what their reserve is it adequate, build it into your working capital analysis, and perhaps have some expedited way of dealing with the seller in terms of being made whole for those claims. Because they seem to come up, when they do come up, they're usually big. You didn't manufacture one thing, you manufactured thousands of parts, and it was a seller who did it, and there's now a defect, but it's coming back while you own the business. And so the dollars, maybe the part was inexpensive, but the dollars add up pretty quick. And you want to keep that customer relationship, so you're not going to charge the customer for it. That's my experience.
Yeah, I think add to that again, in the lower middle market, if this is about taking that first step as an entrepreneur, you're maybe not buying the largest company right out of the blocks. Most of our transactions, most of our financings have a seller debt component. Maybe it's an earn-out, but there's some piece that gets carried back. And I have to tell you, that gets called on a fair amount at the smaller end. As I said earlier, the due diligence is a little more difficult to get to. There is, it's not uncommon to have receivable or inventory issues, sales that got pulled forward that were unclear during due diligence. We've seen a wide range of those things. And so I think for the buyers in the room, the sellers have to maybe close your ears, but for the buyers in the room, I would strongly encourage you to keep everyone's interests aligned for a period of time to get through that transition, because it's not uncommon to have some sort of claim in that first 12 to 18 months.
Okay. What advice would you give to people in the audience that are looking to become entrepreneurs by going out and buying a business? Kind of, we're heading towards the finish line, so a little bit of a kind of summarize. Somebody walks up to you and says, "Hey, I'm looking to buy my first business. What's the one thing you tell them to do?"
The one thing. Well, first of all, charge into it full steam. I think owning and running a business is probably the hardest thing you'll ever do, and one that is also at the same time one of the most fulfilling things you'll ever do. You really do, back to the points made earlier, seek outside counsel and advice in doing this. You're going to be in a much better place. You also have a much higher probability of close. A little known statistic is that most people that try to roll their own on an M&A deal, whether it be a new entrepreneur or even existing business, only have about a 1% chance of completing that transaction. And so that number goes up dramatically with the right team of advisors, and I recommend you seek those folks out.
Yeah, I would just say kiss a lot of frogs. If you're new at it and you haven't done the due diligence, going through that process multiple times will get you better at it, and you'll likely make a better acquisition as a result of that. So don't fall in love with the first one you see, because there'll be other ones. Make sure you understand the business, do that due diligence, and don't be afraid to move on to the next one.
I think it, to some degree, goes back to an earlier question about knowing the why and why you're doing it. Because if you fall in love with that business, making sure that the deal terms are right, and you're going to pour yourself into that after that transaction's done, and you better know the why, because you're going to really want to be in love with what you're doing every day, morning, noon, and night, after that transaction is consummated.
Yeah, those are all great answers. I think make sure you know how you're going to finance it. Talk to a banker. Don't come talk to a lawyer first. Talk to someone who can help you understand how you're going to have to finance it and pull the money together. And as a deal attorney, yes, I can help with that. But I think having realistic expectations about the size of business you're able to buy at the outset is probably really important.
All right. Reminder for everybody, April 3rd, what value does your board bring your business? Hope to see you here. Again, that's in partnership with the Private Directors Association. So thank you for being here. Look forward to seeing you in April. And let's say thank you to our panelists.